We're always told there's a specific rulebook for building a successful startup. Well, today, we're going to tear that rulebook up. We are going to challenge the most common wisdom out there, and it all kicks off with one massive assumption.
I mean, seriously, think about it for a second. It's everywhere, right? The headlines, the podcasts, the entire startup culture seems to scream that the only way to that billion-dollar exit is a road paved with venture capital. But what if that's not the whole story? What if it's not even the main story?
All right, so let's dive right into this. And I want to be clear, this isn't just about opinions or hot takes. We are talking about data. We're going to look at the hard numbers behind this belief that VC funding is the only way to the top.
And this data comes from an absolutely incredible study by MIT researchers called Hidden in Plain Sight. And get this, they didn't just look at a few hundred startups. Nope. They analyzed the records for over 10 million businesses to figure out what really truly predicts success.
Okay, so this is where it starts to get really interesting. The study's first big finding just completely flips the script on that whole venture capital story. They uncovered this massive group of super successful companies that, for some reason, the media almost totally ignores. So here it is, the big number. Are you ready for this? Almost 80%, 80 of all companies that have a huge exit, an IPO or a major acquisition, did it all without taking a single dime of venture capital. Just let that sink in for a minute. The vast majority of these huge successes are built completely outside the VC system. Okay, so that's a huge number, and it begs the question, right? If VC funding isn't the magic secret sauce for most of these successful companies, then what is? What do all these high-growth firms, the VC-backed ones and the bootstrapped ones, actually have in common? Well, what the researchers found is that all these winning startups share this kind of, secret DNA right from the very beginning. They called it a digital signature, basically a set of choices they make right at the start that turn out to be huge predictors of success no matter where their funding comes from. It's a growth playbook. So what's in this playbook? Well, a few things really stand out. These high-potential companies, they're way more likely to incorporate in Delaware. They lock down their intellectual property, like patents or trademarks, super early, within the first year. And they even tend to use these short, catchy, brandable names. So yeah, maybe don't name the company after yourself, huh? And listen, these aren't just little fun facts. They are incredibly predictive. I mean, check this out. A company that does the Delaware thing and files for a patent in its first year is over 120 times more likely to get VC money than other companies. It's like sending up a huge flare that says, hey, we know how to play the game. But, and this is a really key point, it's not just one single playbook. It's more like there are different dialects of the same language. The VC-track companies, they're all about sending signals to attract investors. The patents, the Delaware setup. But the bootstrappers, they focus on stuff like trademarks, things that are tied directly to making money and getting customers. So you see, two different paths, but they're both speaking a language of high growth. And this really pulls back the curtain on what VCs actually do. Their superpower isn't turning a so-so company into a superstar. Not really. Their amazing abilities in spotting the companies that are already on that path. They are just masters of pattern matching. Okay, but hold on, because here comes the twist. If this playbook is so great, shouldn't every single founder just follow it to the letter from day one? The answer, surprisingly, is no. Because blindly following a playbook designed for investors can be a huge strategic mistake. It can kill the one thing you need more than anything, flexibility. And this brings us to the big question you have to ask yourself as a founder. Are you making choices for your actual business, for your real customers, right now? Or are you just trying to tick off all the boxes on some imaginary investor's checklist? So let's break down one of the biggest items on that checklist, incorporating in Delaware. I mean, everyone says you have to do it. It's the gold standard. But why? And more importantly, do you really need to do it right from the very beginning? Okay, the answer gets a little technical, but stick with me. It has to do with something in the tax code called a Section 351 rollover. All you really need to know is that it's a legal way to move your business into a new structure, like a Delaware C Corp, without getting hit with a giant tax bill. It's a totally standard and common thing to do. And here's the absolute key takeaway from that.
You don't have to set everything up perfectly for some investor who might never show up. You can just, build your business. And then when a real investor comes along with a real term sheet, you can use this process to get your corporate structure in order. The point is, you can do it later. You keep your options open. All right, next up on the playbook checklist, intellectual property. You always hear people say, you've got to patent your brilliant idea right away. But is that actually the smartest move for a brand new company?
So it helps to know there are basically two kinds of IP. You've got the formal stuff the playbook obsesses over, patents, trademarks, the things that cost a ton of money in legal fees. But then you have what's called automatic IP. This is stuff like the copyright on your code or your unique business processes, which are trade secrets. The cool thing is, these protections just happen. They kick in automatically the moment you create something. You're protected from day one, and it doesn't cost you a dime.
And let's get real for a second. What does a patent actually give you? It gives you the right to sue someone. It does not give you the millions of dollars you'd need to actually survive that lawsuit against a huge company with an army of lawyers. For a tiny startup, that right is basically just a piece of paper.
So, if the investor playbook can be a trap, what should you do instead? Well, it turns out your real superpower isn't being great at checking boxes. It's being flexible. It's having the freedom to adapt, to listen to your customers, and to jump on real opportunities when they pop up.
So here's a different kind of playbook. Let's call it the Flexibility Playbook. And it's actually pretty simple. Step 1, build something people actually want. Step 2, focus like a laser on your customers and on sales. Step 3, use all that free, powerful, automatic IP we just talked about. And then, and only then, step 4, adapt your corporate structure when you have a real opportunity on the table, not some imaginary one.
I love this quote because it really just nails it. Your job as a founder isn't to fit perfectly into someone else's box. It's to build something so awesome, so unique, that investors are forced to create a brand new box just for you. Real success comes from seizing those unique opportunities, not just following a script.
And that leaves us with one last little thought to chew on. If a huge part of being a successful VC is just pattern matching, just spotting companies that are already following the playbook, well, how long do you think it'll be before an AI can do that job even better, faster, and maybe without all the human bias? Kind of makes you wonder, doesn't it? Thanks for tuning in.